Silver has just pushed back towards $66 an ounce, reaching a 7-week high, and suddenly the conversation is no longer about whether silver can recover. The conversation is becoming much bigger. Can silver make another run toward $100? And I want you to notice something about that question. The number everyone is watching isn't actually $66, it's $100. Because just months ago, silver was trading above $121 before experiencing a brutal correction that took the metal down toward the high $50 and low $60. So what we're watching now isn't a completely new market trying to discover whether triple-digit silver is possible. We've already seen silver trade dramatically above $100 this year. The real question is whether the current recovery is strong enough to take silver back toward that territory, or whether this is simply another rally that eventually runs into resistance and fades. And that distinction matters, because when a metal moves this quickly, investors tend to stop thinking in probabilities and start thinking in targets. They see $66 and immediately calculate what $100 would mean. They start imagining the percentage gain, they start looking at the chart and asking how quickly silver could get there. But markets don't move because a round number looks attractive on a chart. They move because the underlying supply, demand, monetary, and macroeconomic forces create enough pressure to push prices through the next level. So today, I want to forget the hype around $100 for a moment and focus on the mechanism. What is actually pushing silver higher? Why did the metal recover from the high 50s? Why are rate cut expectations suddenly important? Why does silver behave differently from gold? And most importantly, what would have to happen for this rally to become something much bigger than another short-term bounce? Because there are actually two different engines underneath silver right now. One is monetary, the other is industrial. And when those two engines move in the same direction, silver can become extremely powerful. But when they move against each other, silver can disappoint even when gold remains strong. That is the part most simple silver predictions miss. Let's first establish where we are. Silver's move back towards $66 represents a substantial recovery from the levels seen only a couple of weeks earlier. The immediate catalyst highlighted in the source material was the sharp change in expectations surrounding the U.S. labor market and Federal Reserve policy. The July employment report showed a loss of roughly 23,000 jobs, a much weaker outcome than the market had expected, and that helped revive expectations that the Fed could move closer toward cutting rates. And that matters enormously for silver, because silver doesn't pay interest. When investors can earn attractive returns from bonds and other yield-producing assets, holding a metal that produces no income has an opportunity cost. But when markets begin expecting lower interest rates, that opportunity cost can decline. Suddenly, owning precious metals becomes relatively more attractive. And silver doesn't necessarily need the Fed to actually cut rates tomorrow. It only needs investors to believe that monetary policy is moving in that direction. That change in expectations can be enough to move the metal sharply. But there's something even more interesting happening underneath the monetary story. Silver isn't only a monetary metal, it is also an industrial commodity. Solar panels, electronics, electrical infrastructure, and other industrial applications require physical silver. That means silver has a demand base that gold doesn't have in the same way. And this creates an unusual setup. If investors want silver because they expect easier monetary policy, while industrial users continue demanding physical silver, both sides of the market can push in the same direction. That's when things get interesting. Because silver's supply doesn't respond instantly, a higher silver price doesn't suddenly create a new mine next month. Mining projects require significant capital, development time, and infrastructure. So, if demand keeps increasing while mine supply struggles to respond, the market can become increasingly sensitive to investment flows. But there's a catch, and this is where I want to slow down. A physical deficit does not automatically mean silver goes straight to $100. A strong industrial story does not eliminate volatility, and a Fed rate cut narrative can disappear surprisingly quickly if inflation remains stubborn or economic data changes. That's why I'm not going to sit here and tell you that $100 silver is guaranteed. It isn't. What I will tell you is that $100 is no longer an impossible number that requires silver to enter completely unknown territory. Silver has already traded above that level this year, according to the source material. So the debate has changed. We're no longer asking whether silver can ever reach triple digits. We're asking whether the current macro and physical market conditions can rebuild enough momentum to take silver back toward that zone. And before we answer that, we need to understand something even more important. Silver is approaching a major psychological and technical battlefield around the upper $60s and $70 area. That zone could determine whether this recovery is becoming a genuine trend reversal or whether silver is simply heading into another wave of selling from investors who have been waiting to exit. And that is where the $70 wall becomes the next critical part of this story. The next piece of the silver story is the physical market, because this is where the $100 argument becomes more than a chart pattern. The important point is that silver is not simply responding to investor sentiment. It is also a physical commodity with real industrial consumption. And according to the Silver Institute's 2026 outlook, the global silver market is expected to remain in deficit for a sixth consecutive year. Its February forecast put the 2026 deficit at about 67 million ounces, while the later World Silver Survey 2026 described 6 consecutive years of deficits totaling roughly 762 million ounces. Now that sounds extremely bullish on the surface, but we need to look underneath the headline. A supply deficit doesn't mean there is literally no silver available. The market can continue functioning because above-ground inventories, recycling, and existing stocks can help bridge the gap between annual supply and demand. The Silver Institute specifically notes that the market is relying on releases from above-ground inventories. So the real question isn't simply, is silver in deficit? The better question is, how difficult is it becoming to satisfy additional demand? That distinction matters enormously. If investment demand suddenly accelerates while industrial users continue consuming metal, the market has to find additional silver somewhere. Mine production cannot simply respond overnight. The Silver Institute expects 2026 mine production to rise only around 1% to approximately 820 million ounces, while total supply is forecast to reach about 1.05 billion ounces. That is why silver can become extremely sensitive to changes in investment demand. But here is where I want to challenge the simplest version of the bull thesis. Industrial demand is not guaranteed to keep rising forever at the same pace. The Silver Institute actually expects industrial fabrication to decline around 2% in 2026 to roughly 650 million ounces. One reason is the photovoltaic industry, where manufacturers are increasingly trying to reduce the amount of silver used per solar cell or substitute other materials. That's called thrifting, and it is one of the most important counter-arguments to the silver shortage narrative. When silver becomes expensive, manufacturers have an economic incentive to use less of it. So higher prices can eventually create their own demand destruction. That doesn't mean solar demand disappears. In fact, global solar installations are still expected to grow, but if manufacturers can produce more panels while using less silver in each panel, the relationship between solar growth and silver demand becomes much more complicated, and that's why I wouldn't build the entire $100 thesis around solar. There are other industrial areas that matter. The Silver Institute expects data center and AI-related infrastructure, as well as automotive demand, to provide support for silver consumption and partly offset weakness in photovoltaics. That gives us a much more balanced picture. Silver has a structural supply constraint, but demand itself is changing. Some sectors are reducing their silver intensity, other sectors are potentially increasing consumption, and investment demand can swing dramatically depending on macroeconomic conditions. That last component is particularly important right now. The Silver Institute expects physical investment to rise about 20% in 2026 to roughly 227 million ounces, a 3-year high. So imagine what happens if investment demand continues accelerating at the same time that supply remains constrained. The market doesn't necessarily need industrial demand to explode. It simply needs enough incremental investment demand to compete with existing physical consumption. That's where silver can become extremely volatile. And it brings us back to the $70 level. If silver breaks through $70 while investment demand continues strengthening, the breakout would have a much stronger fundamental foundation than a simple momentum trade. But if silver reaches $70 while industrial expectations deteriorate and investment flows weaken, the breakout could become much more fragile. This is why I want to make one thing very clear. The supply deficit is a long-term factor. The price is still a short-term market. Those aren't the same thing. A commodity can remain structurally undersupplied while its price falls for months because investors are reducing exposure, liquidity is tightening, or macroeconomic expectations have changed. We've already seen how violent that disconnect can become. Silver reached above $100 earlier this year, according to the Silver Institute, before falling below $80 and subsequently finding support. So the market has already demonstrated that strong fundamentals don't prevent enormous corrections, and that's exactly why I think the next phase is going to be determined by the interaction between physical scarcity and monetary liquidity. If the Federal Reserve becomes more accommodative while investment demand rises and physical inventories remain tight, silver could receive fuel from both sides. But if rates stay higher, the dollar strengthens and industrial demand weakens. The physical deficit alone may not be enough to prevent another correction. That is the battle happening underneath the chart. And it also explains why silver can behave so differently from gold. Gold can rally primarily because investors want monetary protection. Silver needs that monetary demand plus enough confidence in its industrial future to justify sustained higher prices. So if you're watching the path toward $100, don't just watch the number. Watch the flow of physical metal, watch investment demand, watch industrial fabrication, watch mine supply, and watch whether the market continues drawing on above-ground inventories to balance the deficit. Because if those pressures intensify, while monetary conditions become more supportive, the $100 discussion becomes much more credible. But there is still another force we haven't fully dealt with, gold and the Federal Reserve, because silver's next major move may depend less on silver itself and more on whether the macro environment gives investors permission to chase precious metals again. And that is where the Fed, the dollar, and gold come back into the story. Now the macro side becomes critical because silver doesn't move toward $100 on supply fundamentals alone. It needs the monetary environment to cooperate. And right now, the Federal Reserve, the dollar, gold, and inflation expectations are all interacting with silver at the same time. The first thing to understand is that silver is effectively a higher beta precious metals trade. When gold strengthens because investors expect easier monetary policy or seek protection from uncertainty, silver often responds with larger percentage moves. But that leverage works in both directions. A stronger dollar or a more hawkish Fed can pressure silver disproportionately. We've already seen that relationship this year. Earlier in the correction, silver traded around the high $50 while markets were pricing a meaningful probability of a Fed hike, showing that monetary expectations could overwhelm even a supportive physical supply story. Now, the narrative has shifted. The July jobs weakness has pushed investors toward the possibility of easier policy, while gold has also been strengthening. On August 12th, gold was trading around $4,387, with markets waiting for US CPI data that could influence the next phase of Fed expectations. And this is where silver's next major move could be decided. Imagine two different scenarios. In the first scenario, inflation remains manageable, labor market weakness continues, and the Fed becomes increasingly comfortable with easing policy. That would potentially reduce real yield pressure on precious metals, weaken the dollar, and give gold another leg higher. If gold moves higher under those conditions, silver could receive an additional momentum boost. The second scenario is very different. Suppose inflation comes in hotter than expected. The Fed becomes more cautious about easing, Treasury yields rise, and the dollar strengthens. Suddenly, the opportunity cost of holding silver increases again. And because silver is more volatile than gold, the reaction could be larger. That's why I don't think the $100 question can be answered by looking at silver alone. You have to watch the gold-silver relationship. At present, silver is catching up strongly. Recent market data shows silver around the mid-60s, while gold is above $4,300, and the gold-silver ratio has compressed significantly from the much higher levels seen during the correction. That compression matters because it tells us silver is gaining relative strength. But relative strength doesn't automatically mean silver will continue outperforming. Sometimes the ratio falls because silver is rising faster. Sometimes it falls because gold is temporarily weaker. And sometimes a rapidly falling ratio can become a warning that the silver move has become crowded. So I would watch the ratio as a confirmation tool, not as a standalone prediction. There is also another important factor developing underneath the precious metals market: central bank demand. Central banks don't generally accumulate silver as a reserve asset in the way they accumulate gold. But their continued gold buying can strengthen the broader monetary narrative surrounding precious metals. Recent data indicates central banks purchased nearly 289 tons of gold in the second quarter of 2026, up 62% year over year. That doesn't mean central banks are secretly buying silver. They aren't. But it does show that institutional demand for monetary protection remains relevant. And when that demand pushes gold higher, silver can benefit indirectly through investor rotation. This is one reason silver can sometimes appear to wake up late. Gold establishes the monetary trend first. Then investors begin searching for greater upside exposure, and silver becomes the higher volatility alternative. That's a powerful mechanism, but it also explains why silver can become overheated quickly. Now let's return to $100. At approximately $65 today, silver would need a move of a little over 50% to reach $100. That's a large large move, but it isn't unprecedented for silver. The metal has already demonstrated extraordinary volatility this year, with Trading Economics recording a 2026 high of approximately $121.64. So mathematically, another move toward $100 is possible, but possible is not the same as probable. For $100 to become a serious medium-term scenario, I would want several conditions to remain aligned. A supportive Fed trajectory, contained or falling real yields, a reasonably cooperative dollar, continued gold strength, persistent physical market deficits, and strong enough investment demand to absorb the available supply. If several of those disappear simultaneously, the probability of reaching $100 falls. If most of them remain aligned, the probability increases. That's the mechanism, not a secret target, not a guaranteed forecast, and certainly not a straight line. There is one more issue investors need to understand: oil and inflation. Today's market is already dealing with renewed geopolitical tensions and higher oil prices. Reuters reported August 12th that oil and gold were both rising as geopolitical tensions increased ahead of US CPI data. Higher oil can create two opposing forces for silver. On one side, geopolitical uncertainty can increase safe haven demand. On the other, higher energy prices can create inflation pressure that makes the Fed more cautious about cutting rates. So even a bullish-looking geopolitical event can create a complicated monetary reaction. That's why I keep coming back to the same point. Don't trade the headline. Understand the transmission mechanism. A headline matters only because it changes something underneath: rates, yields, the dollar, inflation expectations, physical demand, or investor positioning. And right now, all of those variables are moving quickly. So the next phase of silver isn't simply about whether buyers can push it from $66 to $70. It's about whether the macro environment can support a sustained move beyond $70. If it can, then $80, $90, and eventually $100 become legitimate levels to monitor. If it can't, $70 could become the point where the rally runs into reality. And that brings us to the final piece of the puzzle. What would actually invalidate the bullish thesis? Because if we're serious about analyzing silver rather than selling a dream, we need to know exactly what evidence would tell us that the $100 scenario is becoming less likely. Now we can bring the entire argument together, because the $100 question ultimately comes down to one thing: what would have to remain true for silver to make another major leg higher? At around $65, $66, silver is already showing significant momentum. Trading Economics currently has silver around $65.20 on August 12th, with the January 2026 high listed at $121.64. That means $100 is mathematically possible without requiring silver to establish an entirely new record. But possibility is not probability, and that's the distinction I want to keep throughout this analysis. For silver to make a sustained move toward $100, I would want to see several forces continue working together. First is the Federal Reserve. The current market is waiting for U.S. inflation data because it could materially change expectations around the Fed's September decision. Reuters reported today that economists expect July CPI to rise 0.1% month over month and 3.4% year over year, while core CPI is expected at 2.5% annually. If inflation remains contained while labor market weakness continues, the argument for easier monetary policy becomes stronger. That would potentially support gold. And if gold continues higher, silver could receive another wave of momentum. But the opposite scenario matters just as much. If inflation proves hotter than expected, oil prices continue creating inflation pressure, and the Fed becomes more cautious about easing, precious metals could face renewed pressure. Reuters notes that markets are already watching rising oil prices and geopolitical tensions because both can complicate the Fed's policy decision. So the first major invalidation signal is simple. If the rate cut narrative disappears, silver's short-term bullish momentum becomes much more vulnerable. The second thing I would watch is the physical market. The structural deficit remains an important part of the long-term thesis, but investors should not treat a deficit as a guarantee of higher prices. Supply can be supplemented by recycling and above-ground inventories, while manufacturers can respond to higher prices by using less silver. That's why the real bullish confirmation would be continued investment demand on top of resilient industrial demand. The third signal is gold. Silver doesn't have to outperform gold every single week, but a sustained move toward $100 would be easier to justify if gold remains structurally strong at the same time. Right now, gold is also consolidating ahead of the US CPI report, with traders watching Fed expectations and geopolitical energy risks closely, and that gives us a very useful framework. If gold continues higher, silver breaks through $70, physical demand remains strong, and monetary expectations become more supportive, the $100 scenario becomes increasingly credible. But if silver repeatedly fails around the upper 60s or $70 area, gold loses momentum, and Fed expectations turn hawkish again, the market could easily move back into consolidation. And I want to emphasize something here. A pullback would not automatically destroy the long-term silver thesis. Silver is one of the most volatile major commodities. Even strong long-term trends can contain brutal corrections. So if silver moves from $66 to $58, that doesn't automatically mean the bull market is finished. It means the market is testing conviction. The more important technical warning would be a sustained breakdown below the recent recovery structure. That's when we'd have to question whether the current rally was primarily short covering and momentum rather than a genuine trend change. And that brings us back to $70. For me, $70 is more important right now than $100. Why? Because $100 is a destination, $70 is confirmation. If silver can establish itself above $70 and turn that former resistance into support, the market would have demonstrated that buyers are willing to absorb the sellers who have been waiting to exit. That would make the next upside levels much more interesting. But if silver repeatedly reaches $70 and gets rejected, then the market is telling us something. It's saying the recovery isn't ready yet, and that's perfectly normal. Markets don't owe us a straight line. So my base case isn't silver will definitely hit $100. My base case is that silver has entered a high volatility decision zone. The macro backdrop has improved. The physical market story remains important. Gold is providing support, and the market is approaching a critical technical area. But the next confirmation has to come from price behavior and macro data together. That's why I would watch 4 things over the coming weeks. Number 1, the Fed. Does the market continue moving toward easier policy? Number 2, inflation. Does CPI give the Fed more room to ease, or does energy and services inflation keep pressure elevated? Number 3, $70 silver. Does silver break and hold above it, or does resistance send the metal back down? Number 4, physical demand. Does investment and industrial demand remain strong enough to keep pressure on available supply? If those 4 variables line up, then the conversation around $80, $90, and eventually $100 becomes much more serious. If they don't, another correction becomes entirely possible. And that's the conclusion I want you to take away. $100 silver is plausible. It is not guaranteed. The metal has already demonstrated that extreme upside moves are possible, but it has also demonstrated that extreme corrections can happen just as quickly. So don't let a round number become your investment thesis. Don't let one bullish headline become your confirmation. And don't let one bearish candle convince you that the entire structural story is finished. Watch the mechanism, watch the Fed, watch inflation, watch gold, watch the physical market, and most importantly, watch whether silver can turn $70 from resistance into support. Because if it does, the market may be telling us that this recovery is becoming something much bigger. And if it fails, patience may once again prove more valuable than prediction. This is analysis, not a guarantee or personal financial advice. The market will decide whether $100 becomes the next major destination, and our job is to understand the forces that could take it there before the headline tells us what happened.